Hello everyone, and welcome to today's webinar titled Management by Metrics, the Smarter Way to Manage Your Software Company. My name is Rihanna Collier, and I am the Vice President of the Software Division at SIIA. I am joined today by Lauren Kelley, CEO of OPEXEngine. For those of you who don't know OPEXEngine, they provide high-quality benchmarking for performance management. Also with us is Marc Linden, CFO of Intacct, and Intacct is a leader in financial management and accounting applications. I'm very delighted to have both Lauren and Marc here today to share some best practices on using metrics to better manage your business. For the past 4 years, I believe, the SIA has partnered with OPEXEngine on their annual software and SaaS benchmarking study. And what we found is that the most successful software companies use metrics as a key management tool. And we just recently released this year's report, which Lauren will talk more about. And so today we wanted to bring some of the data and the best practices for use of that data to you in today's webinar. Next slide, please. Before I turn it over to Lauren and Marc, just a couple of housekeeping reminders. First of all phone lines are on mute. The webinar is also being recorded, and we will provide the full recording and presentation to all participants following the webinar. Next slide. We do want to make sure that we answer all of your questions, so be sure to ask your questions at any time throughout the presentations via the chat box to the left of your screen. We'll let Lauren and Marc get through their presentations first, but then we'll address all of your questions in the last 15 to 20 minutes or so of the webinar. And then quickly, I want to take a moment to highlight a couple of upcoming SIA events and activities that might be of interest to you and or your colleagues. First is our annual Cody Awards. The Cody Awards season is in full swing right now, and we are still looking for judges in the categories listed there on your screen. If you have any particular expertise in these categories, I encourage you to apply to judge. Judging the Codys is a really great opportunity to get first-hand access to some amazing products and solutions. The URL is there on your screen, so it'll take a couple minutes and you can sign up there. And then finally, I want to mention our upcoming Deciphering Finance event taking place December 4th just outside of Boston in Cambridge, Massachusetts. This is an exclusive event for finance executives and CEOs to discuss growth strategies for software companies. So all qualified finance executives and CEOs are invited to attend free of charge as our VIP guests, and also have the opportunity to earn up to 6 hours of CPE credit for attendance. Space is limited. We do expect to reach capacity, so if you're interested in attending, I encourage you to register as soon as possible. And we'll follow up and provide that link in the follow-up to the webinar with the recording and presentation. Also very proud to say that the two companies we have represented today, OPEXEngine and Intacct, are both sponsors of this particular event, and so they will have executives on site if you have any follow-up questions from this particular webinar. So with that, I don't want to take any more time. I want to turn it over to the bulk of the content, and I'd like to introduce Lauren Kelley, CEO of OPEXEngine. Lauren?
Hi everyone. Thanks very much, and good morning on the West Coast, and good afternoon on the East Coast. Thanks very much for joining us today, and thank you to the SIA for organizing this, and Marc from Intacct for joining me on this presentation where we're going to talk a little bit. It's a deep subject and lots to discuss here on metrics and benchmarking. Just to introduce myself quickly, I started OPEXEngine about 6-7 years ago, and our focus is on developing financial and operating benchmarks for the technology industries. I spent about 20 years in tech industry, built up some fairly large businesses, have taken companies public, worked in public companies and also private, and always felt that there wasn't good enough comparable data that was focused on operating executives as compared to most data that's out there is really focused on investors and how to make a good investment decision. But when you're running a company and you're trying to make those day-to-day operational decisions, you need the data and you need comparables that are good comparisons for your company and not just an average of everybody in the industry. So that's what we've been working on, and we're very lucky to have worked with a lot of really fabulous companies over the past 6-7 years. Quite a number have gone public, a number have been acquired, and just lots of other ones have grown very fast. So we'd like to share some of the learnings that we've had. This has been an interesting period the past 6-7 years as the software industry has moved from what traditionally was a model of selling perpetual on-site premise licenses that you recognize all the revenue up front to many, large bulk of the industry, particularly a large percentage of new companies that have been established in the past 10 years are based on a subscription model, which has a lot of implications, not just for the financials and the benchmarks, but obviously also from a management perspective and a whole host of other things that make it different in terms of looking at the metrics for a company. So if you could move the slide to our next, progress to the next slide. We have two different major products. One is our confidential benchmarking, which we run once a year. And we currently have the 2013 data. Could you move the slide forward to the next slide? Thank you. We have about half the companies participating in the benchmarking are public companies, half the company are private. We cover companies with revenues between $1 million and just under $500 million. And of the private companies that participate, the bulk of them are subscription-based, but we have a whole variety of models, companies that are a mixture of subscription-based and perpetual license, as well as companies that are pure perpetual license companies. So if you could move to the next slide. One of the things that we think is most important when you get started benchmarking is to think about who your peer group is. And lots of companies look at benchmarking as in the same way that they look at. And when you do market research, you're looking at other companies that are selling the same product, and you're looking at the size of the market. Whereas when you're looking at your financial structures and you want to understand what are the right structures, what are the right expense ratios, what are the right metrics at this stage of my business, you want to look at companies that are at a similar point in their business. And if you could progress the slide, please. I think for all of those who are listening, you'll know we're having a little bit of trouble with the web system that's running the slides here. So if you can bear with us, it's much appreciated. We think it's much more important to look at companies that are at the same stage of growth as your company. So whether you're early stage, mid-stage, late stage, whether you're venture-backed versus non-venture-backed, because that's going to have a big impact on, obviously, the capital that's available, and also the goals of your company. If it's just revenue growth at all costs versus profitability, then you're going to structure your spending and your sales and marketing, your R&D in a different way. And I say this because so many companies today come to me and say, well, our board says we need to look at Salesforce.com and compare ourselves to them. And, this may be a $10 million company that is in a new market. And comparing yourself to a $2 billion public company is great if you're comparable to that company and at that same stage. But if you're not, then your metrics are going to be quite different, and it makes sense to compare yourself to companies that are at the same stage. In the same way that it's important to compare yourself to companies that maybe with the same average selling price or in the same range, because there's a big difference between a company that is structured to sell a high volume of product, low-cost product, and maybe you have a huge investment in inbound marketing and a web system and very little investment in outward bound sales, versus if you're selling an enterprise software product, whether it's in a subscription model or not, with a high average sales price, then you're going to have a completely different sales structure, different marketing structure, different product development structure for your enterprise clients than you might have for the high volume company. So now if you can move to the next slide. What we like to do is also what OPEXEngine has a tremendous amount of experience with is working specifically with SaaS companies and looking at the metrics that executives use to define the SaaS model. Because again, SaaS is a model that is really numbers driven. It's all about adding customers. And it's about adding them profitably, and it's about retaining them profitably and building upon your renewable revenues. So first and foremost, obviously, you're looking at recurring revenue or annual recurring, either monthly recurring revenue or annual recurring revenue. And there's been some discussion in financial circles about whether you have to look at just what your recurring revenue, your monthly revenues are, whether you just look at the contracted recurring revenues. Contracted recurring revenue is the revenue that you can depend on, whereas your monthly revenues may vary from that somewhat because you may have one-time only or short-term additions to that revenue, and that's not necessarily what you're building your business on. And then looking at how you grow. How fast are those recurring revenues growing? And also how fast is your increase in subscriptions or increase in number of customers, and what your recurring revenue per subscriber is. And that really comes, one of the major differences, I think, between a subscription business and a perpetual license business is that there is so much more of a focus on metrics around the customer, the numbers of customers, the renewals of the customers, the cost of acquiring the customer, and then your customer lifetime value. And it's important also to look at these metrics in relationship to each other. So, for example, we get lots of questions about, is this cost of customer acquisition a good one or is it a bad one? And in isolation, it's hard to say. If you have a high cost of customer acquisition, that might be fine. If you're selling something quite expensive to the customer, then that's fine. If you're selling a low-priced product and your cost of customer acquisition is high, then obviously that's probably not a great business model. So customer lifetime value is a metric which incorporates your monthly recurring revenue from a customer and multiplies it over the lifetime. So generally that's considered 4 or 5 years. But then takes into account your probability of keeping that customer by multiplying it by your renewal rate. So if your renewal rate is 89%, then you'd multiply that by 0.89. And then it also takes into account the profitability of that customer. So you would multiply that by your gross margin percentage. So if your gross margin is, say, 72%, then multiply that by 0.72. And then you come up with a number which represents the value of that customer. And you've already calculated to some extent the probability of keeping that customer. And then you can compare that against the cost of customer acquisition and see, the payback period as well as the profitability. So if we move to the next slide, we can see another, if we dig into one of the metrics that's talked about and is very important in the SaaS world, And it's very important because we could do a calculation showing that for all the new customers that you add, saving one customer or reducing your churn will get you more than adding customers. And let's get into, if I show a gross churn example, which is just looking at the number of customers that I have, 100 subscribers, and if I lose 10, then that's about a 10% churn rate. But even if I had 100 original subscribers and I add 5 more, but I still lose 10, I still have a 9.5% churn rate. So even though I've added 5, it hasn't reduced my churn by 50%, but only by 0.5%. And so you could do a calculation in terms of how your revenue would build, and you would see that you can't grow if you had a 20% churn rate. You really can't grow your company, and ultimately you would lose your customers over time. So then we also look at churn not just in terms of the number of customers, but also in terms of your revenue renewal rate. So if I had 10 customers and I renew 90% of them, that's a 90% renewal rate by customers, all other things being equal. But if I had $10 million in contracts that were up for renewal, and even though I lost some customers, I renewed $9.5 million in contracts, that would be a 95% renewal rate on the dollar value. And one of the things that we've seen consistently in our benchmarking over the past 7 years is that companies tend to have a higher revenue renewal rate than a customer renewal rate. We also have seen some interesting trends in the sense that typically bigger companies have better renewal rates than smaller companies. And similar to that, or another important trend to keep in mind, is that companies with larger average sales or contract values tend to have higher renewal rates, and companies with high volume, low priced products tend to have lower renewal rates. And that's typically because the cost of their product's not as sticky, the cost of a customer changing is not so great, and the cost of acquiring that customer, and you're dealing with large volumes of customers, so they tend to churn at a slightly higher rate than larger enterprise type customers. So if we move on to some of the specific benchmarks, if you could move to the next slide, please. We looked at private companies, and if we break it out into 3 groups, companies with revenues less than, and these were in this particular case just SaaS companies. We break our benchmarks down by SaaS companies, perpetual license companies, hybrid companies. We look at it by size of revenues, by contract values, by numbers of customers, and a variety of other metrics. But in this case, just looking at focusing on SaaS companies in 3 groups. One of the things that we see is that what's interesting in this past year is that the smallest companies actually had positive operating income on average, and that the larger the companies got, that the operating income went dramatically down. And I think that reflects sort of the nature of funding and venture money going into some of these companies. And we have seen over the last couple of years that companies typically, especially venture, the bulk of companies are venture-backed, and those companies at the range of 18, 20 million or so tend to take a very large possibly final funding round, and put a huge amount of money into sales and marketing and really going all out, and growth rates dramatically increase at that point. And that obviously drives down operating income. And you can also see that those companies hire, the growth in hiring. The expectation is to continue growing in terms of hiring. And if you see it on the bottom line, the dollar amount of investment capital, the companies under 10 million, just under 5 million in invested capital, whereas the companies over 20 million have, on average, about 60 million invested. So there's definitely a lot of money being invested in SaaS companies, and that money is primarily being invested to drive sales and marketing and revenue growth, and also infrastructure to support high growth. So if we go to the next slide, we can also look at churn rates or renewal rates here for both private companies, for hybrid companies, and for public SaaS companies, just to compare. And again, this, as I said before, smaller companies tend to have greater churn or less high renewal rates than public companies. Some might say that's sort of the definition of a bigger company. A company would not get bigger, as we described in terms of the churn equations. You can't get bigger unless you improve your churn rates. But what's interesting is the high renewal rates for hybrid companies, and that partially relates to the fact, of course, this is only looking obviously at their subscription customers, but shows, at least with the companies that we've looked at, are doing a very good job of transitioning their customers from perpetual license to subscription basis. And they may not be growing the contract value as much, because it's very unusual to see the customer renewal rate and the dollar renewal rate to be almost exactly the same. But that's also part of maybe the transition of becoming a SaaS company, because a SaaS company or building a SaaS business, companies do tend to increase their, and have as a goal of the company, to increase their revenue per customer in a variety of ways. So if we can move to the next slide, we can look at just a quick look at venture-backed versus bootstrap companies. This year we broke out the data that way, and it's quite interesting to see, fundamentally the difference is that venture-backed companies have the capital, obviously, to spend over revenues, and they are putting that money typically into sales and marketing, and as I said, some into infrastructure, hosting, and the like, to build out a scalable infrastructure for a large growth in customers, as compared to non-venture-backed companies, which it makes sense, have to cover their costs out of revenue, and therefore have lower rates of growth, although a revenue growth rate of 13% is not terrible, and they're profitable. And we're seeing more and more companies throughout the United States growing up along this model. So then if we go to the next slide, we can see, I just thought it would be fun to see for companies, some of the most recent companies that have gone public, looking at their average revenue growth in their IPO year. So this ranges from Salesforce.com earlier in the year, in 2004 through last year, And typically the growth rates are very, very high, even though these are 100 million and above companies. And then if we look at gross margins, if we go to the next slide for these companies, it's interesting that they're fairly consistent. And if you look at the comparison between these companies, specific companies that we're showing against the SaaS industry average for 2010, 11, and 12 versus software industry, including perpetual license companies. And gross margins are very consistent to some extent. There's not that much deviation off of the 67 to 70% gross margin. And then if we move to the next slide, and we look at public company profit trends, one thing that's been sort of interesting is this definitely reflects, public companies much more than private companies reflect the macroeconomic conditions. And so if you look at operating income for 2008, where most companies were still in a high growth, the SaaS industry was really just becoming quite popular. So companies were spending, even public companies were spending over revenue at a negative 3.3%. And then in fiscal year 2009, the recessions hit, and numbers are reflecting that. Public companies cut back tremendously and became profitable. Then 2010, 2011, pretty consistent in terms of not cutting back quite as much as in 2009, but still being profitable. And then an interesting phenomenon in the past year or so, obviously the stock market's done very well. And in addition, it's been clear, especially with SaaS companies, and I should mention these averages reflect companies up to 450 million. So this is not reflecting the very big software companies, but the relatively newer public companies. The stock market's been rewarding high growth over profits. So what's interesting is last year, and I think we'll continue to see that this year once the numbers are in, have dropped a little bit in terms of profitability. So then if we go to the next slide, you'll see also where they were spending some of that money. And especially SaaS companies, as compared to hybrid or on-premises software companies, were spending over 100% in total expenses this past year, and spending more of it in sales and in marketing than the hybrid or on-premises companies. So just to start wrapping up, if we can go to the next slide. Again, after working with so many companies over the past 7 years in looking at benchmarks and helping them figure out financial models and planning for the next couple of years, we've found that companies that are, and this is just anecdotally, but I can say absolutely, the most successful companies out there, very metrics driven, and not just metrics driven in terms of looking at their own metrics, but in terms of comparing their metrics to third parties, using third-party data to look at comparable companies, and using that in the budgeting and planning process, using that in management reviews and setting targets, using that to make sure that everyone on the executive team is working off of the same playbook and understanding what comparables with other companies are, and using the benchmarks to understand and stay on top of changes in the environment and with other comparable companies. Because if there's one thing obviously we all know is that the software industry is very dynamic and new, and the business model continues to evolve. So if we go to The next slide, I always like ending with this slide. I think after 25 years in the business, business is very much like sports. And, to maybe carry my metaphor to the absurd level, if you think about an athlete, their product in a sense is their body. And they focus on, having a great athletic body, just like we focus on having great software products. But you can train, and that's how an athlete wins, is by intense training. And as software companies, we work very hard to execute very well. But athletes, also the top world-class athletes, compete by constantly looking at their competitors and looking at everyone around them and then using that information in order to improve their own performance. And so that's my metaphor for why everybody should be benchmarking their business performance. So just to conclude, we will be running the annual benchmarking, if you move to the next slide, kicking off at the beginning of the year. We work with companies if they want data now and want to couple this year with next year's benchmarking. We'd be happy to do that, and we have lots of companies that do that as you finish up your budget process now at the end of the year and want to plan for the next year. So stay in touch, and we'd be happy to work with you. And with that, I would love to turn it over to Marc Linden, CFO of Intacct, which is many of our benchmarking clients are Intacct customers and using Intacct to pull up the data that you need to use for managing your company and benchmarking it. So thank you.
Great. Thanks, Lauren. My name again is Marc Linden. I am the CFO of Intacct. I've been here for just under 6 years, trying to put some of the measures that Lauren had mentioned or in use in the SaaS industry into practice. So I thought what I'd do today is spend a few minutes to share a bit of a practitioner's view and go into a little bit more detail on a couple of these measures kind of from the CFO's perspective. Next slide, please. So let me start just talking a little about what does all this mean for the CFO themselves? Because I think it's not just the measures, it's also the whole business is changing. The way you view the business is changing, and ultimately even the role that you're playing in a recurring revenue software business changes over what we're all used to in traditional on-premises software in some not very subtle ways. So first is really, who is the forward-looking person in the organization? In a traditional software company, it's the head of sales. They're coming up with a sales plan and a bookings plan, and they're responsible for executing it. And really the CFO basically takes the results that came into the door. There's a significant role in Rev Rec. There may be even a role working with sales structuring for Rev Rec. But it really is more of an after-the-fact type of role. In a SaaS company, it's very different because what happens today affects the run rate of your business forever into the future very significantly, and because it is no longer a relatively straight calculation to figure out a booking today is $1 of revenue when, the CFO is much more actively involved, and the CFO really becomes the one that is viewing the long-term health of the business and really taking ownership for making sure that the trade-off is made between the different components and that the right things are done to get all these different measurements and business levers into alignment. You also spend a lot more time in the contract development and procedural development because that's very important in not only the delivery of a SaaS application, but also how it's viewed and contracted for after the fact. So next slide, please. So let me go through, So I think, Lauren did a nice job going through, some of the measures. There are quite a few of them. Most of them are new. And what you find in practice is that, the day-to-day measurement of your SaaS business is all completely new. So let me go into a couple in detail. Next slide, please. And kind of, share some of my operational view, having actually put this into practice from, fairly early on days in the current SaaS transition. So first, let's turn to MRR and CMRR. So monthly recurring revenue and contracted or committed monthly recurring revenue. First, MRR. So that is the number one metric. Every SaaS company ultimately is measuring themselves based on this. If some people use ARR, annual recurring revenue, but if you're really doing annual contracts, ARR is very easily related to MRR, just dividing by 12. But I think, typically MRR is the number one measure and the unifying one across SaaS companies. What it is it's a measure of the predictable recurring revenue of your recurring revenue business. So almost by definition, we're talking about subscriptions or predictable usage-based components of what you charge your customers. So it excludes one-time fee items like setup charges, professional service implementation charges, one-time consulting for your customer for use of your product. Those would be excluded. Not that they're not revenue, but they're not a measure of the recurring revenue from your customer base. It could also exclude, and really dependent on your specific business of what is valuable for you to measure, but oftentimes excludes highly volatile revenue components. So if you have overage charges, very typical structure, where a customer will buy a committed volume and then you'll have a penalty overage structure. Those can be very, very large, but they're unpredictable and they're certainly not recurring in your business. So it's not necessarily a great measure of what your future revenue is going to be, which is really what you're trying to do with an MRR measure, is look into the future. And unless you have a very solid, predictable track record for those kind of volatile components of revenue, you typically would exclude them from MRR. Now, CMRR, contracted monthly recurring revenue. Closely related measure. Basically, you start with MRR, and then you take into account known future adjustments to MRR. So if you have contracts that have been booked and committed by the customer that are not yet in the contract term, so not yet revenue, maybe not even yet invoiced to the customer, you would add that into MRR because that's a committed component. You're looking into the future as to how your MRR is going to change, and you basically say, hey, I know that that customer starting 3 months from now is going to pay me an extra $100 a month, and you'd add that $100 to get CMRR. Similarly, if you know of future cancellations, customers already given you 30-day notice that they're going to leave, or they've signed signed a downgrade order, or canceled part of their subscription even though it hasn't taken effect. You're going to take into account that forward event into MRR from the downside. So really important to note, neither of these are defined industry measures. There's no GAAP guidance for them. There's no even industry standard. They're comparable roughly between businesses, but you really need to make them your own and adapt the how you actually measure it and the details of the measurement to your business in a way that just helps you understand the dynamics. The most important thing is getting it right as your own business measure and being consistent over time so you can see the trending of your overall business. That's really what you're trying to get at. You're measuring that recurring cadence of your SaaS business. Next slide, please. So this is actually one of the ways that I present period change in CMRR, so slightly different context. So we're not just measuring CMRR at a point in time. Again, we're trying to look at that cadence of the business, and we're looking how CMRR changes over time, net change in CMRR. So what we're doing is looking at the components that make up either an increase or decrease in CMRR, can also do this for MRR, from the beginning of the period to the end of the period. So at a minimum, you want to break out, the different reasons for adding and subtracting business. So what's new? New customers, new contracts in the door. What has your install base done? What have they added on during the period in terms of new business? And then churn. Churn can be cancellations, but it can also be other things that happen at the time of renewal. So within churn, you can even go to more detail if it's relevant and break out actual contract cancellations, downgrades, or upgrades at the time of a renewal. Typically, those would be price increases, but there may also be add-ons at the time of a contractual commitment. And then if you have anything else, different channels, any other adjustments, you want to capture that, in the aggregate if it's small. Otherwise, break out those components. So what you're trying to do is look at the puts and takes that are affecting your change in the run rate of your revenue over time in a way that you can see what's actually going on. So, as Lauren mentioned, if your churn's not under control, you can't possibly compensate for the new business in the door. If you graphically represent it like this, you're going to very clearly see those ratios. And you can see in this example, churn is relatively low and, significantly smaller than the upside components, new business and add-ons in the business. And this is a business that's going to be growing, very healthfully over time. Next slide, please. So that's one component of looking at the health of a SaaS business. So you basically said, am I advancing the revenue run rate of the business? Well, that's great, but what's the cost of getting those additions in the business? Because, different pricing model than traditional on-prem software. You're not getting paid $1 up front. You're getting paid a fraction of $1 over multiple periods into the future, basically allowing your customer to pay as they use your software. Very different model. So you have to account for that time value of money and the cash flow inherent of spreading that payment stream into the future. So couple of different measures to look at on that front. And ultimately the question we're trying to answer here is the cost of getting a customer in the door going to pay off both in the short term but also in the long term of the life of that customer relationship. So a couple of different measurements. First, CAC, cost of customer acquisition, cost of acquisition of a customer. What that measure is your total cost of sales and marketing less any cost attributable to renewals divided by the number of new customers you got in the period. Now, there's two ways you can define the period of the expense that you're looking at. One, you can just do it in a current period. Total marketing and sales in this quarter divided by the number of customers in this quarter. There are some measures where you time lag that measure, where you would take the marketing and sales expenditure of a prior quarter divided by customers acquired in this quarter. The argument there is if I spend $1 last quarter, I'm not going to get a customer for at least a quarter. Industry measures like Omniture's magic number take into account that time lag. But to simplify it, most companies just do it within the period. So that's going to give you a unit economic view of the total marketing and sales cost of acquiring a customer. Okay, that's good, but you then also want to know what can I expect from that customer over the life of that customer relationship, customer lifetime value. And that is the total expected revenue, so the initial contrast, any upgrades, any add-ons, any downgrades if that's a normal part of the business, over the expected life of a customer relationship. Do the expected life as just the inverse of the churn rate. Very simple way to look at it. And then the payback period is just comparing those two. So cost me $1 to get a new customer in. I make $1 of revenue per year from that customer. That's a payback period of 1 year. If I make $3 over the expected life of that customer, I'm going to have a net payback of a positive 2, and then you can gross margin affect that and take an NPV and an IRR of that stream of financials for that customer. So if we turn to the next slide, I'll actually show some examples of that, and these are actual models that I put together a number of years ago that I'm using in the business. And first, CAC. So in our business, we are multi-channel. It's one of the key things about CAC, since you're talking about, fundamentally your go-to-market strategy of how you acquire a customer. You really want to look at this by channel, and this is just, our direct channel. And the components here, there's nothing magic to them. It's broken down into components that make the most sense for you to measure your business. So if you're consumer-oriented and, you have multiple components of lead gen and advertising and web acquisition, you may want to have 3 or 4 different components of that internet marketing spend detailed so you can see where you're spending the money. In our case, it's primarily marketing programs, personnel, product marketing, and direct sales, meaning salespeople plus sales support activities. Those are our buckets of expense, and there was no magic. Those are the major buckets, groupings of expense in marketing and sales. And I'm looking at it 2 ways. Looking at it on an absolute dollar basis, so I can understand the unit economics. I can compare $1 of customer acquisition cost to how much it costs to how much I make from revenue from that customer. Also doing it on a percentage basis. A percentage basis is a great way to show you where your costs are coming from, to benchmark with external parties, and also a great way to look at the trend over time. Next slide, please. So switching then to customer lifecycle value, and I'll show how the two are compared. So basically, lots of assumptions. What's my starting ASP? How much do I get in price enrichment every year? What do I expect in add-ons from that customer, both from user ads, and in our case, we also have add-on modules. By the way, these are examples, but all the numbers have been disguised to protect the innocent. And then what is the expected customer life based on the experienced churn rate? An example here is 8 years. Then I'm also taking into account our gross margin and cost of capital. And again, you can see in the spreadsheet at the bottom of the page, I'm now generating an expected revenue stream from that customer. I'm going to have the initial contract. I'm going to have price increases over time, and those are obviously cumulative. So, I get the first year price increase, the second year it builds over time. Same with user growth and add-ons. And that's going to give me an expected customer lifecycle value, and you can see how the growth rate for an individual customer is going to look. Next slide, please. Now, if we put that all together, you can start building a view of the actual unit economics of a customer relationship. So I've taken that expected revenue stream on the top line. I've gross margin affected it at the 72% example gross margin I used here. And then I've looked at my costs of that customer relationship. Year 0, before I ever get $1 of revenue, I have my acquisition cost, CAC. I also have some ongoing sales costs and marketing costs for renewals to support that install base. They're smaller, but cumulatively over time, they're significant. Doing the math, I get a contribution customer each year, and as you can see, losing money beginning the relationship, but I start making it over time. And now you can look at that on a cumulative basis, which is a cumulative revenue, then cumulative gross margin contribution, and cumulative cost, and the net of those. So in this example, almost break even in year one on a revenue basis, but not making money on a contribution margin basis until sometime in the second year of a relationship. You can do the math, calculate your revenue break even at 1.3 years and your gross margin break even in 1.6 years, which if you benchmark will be, considered a fairly healthy SaaS business. I also like to take the net present value of the contribution margin, and an IRR. It's a great way, if you're venture-backed, to compare that to venture hurdle rates. So next slide, please. So that really concludes, a couple of examples here. It can go into much greater detail. Intacct does have a number of seminars where we share, both information about Intacct, but also our learnings on some of these areas. So we've actually put SaaS metrics and our software into practice. So Rihanna, with that, let me turn it back to you.
Thanks, Mark. Thanks, Lauren. This was great. And we are approaching the top of the hour, but I just want to ask a couple of quick questions. Mark, for you, and I know you've participated in the benchmarking, and you look at these benchmarks. Is it a difficult process? Is it a long process? Does it take a lot of time?
When you start, it takes a lot of time, not because the benchmarking is hard, but because getting these measures in place in your business is pretty hard.
Mm-hmm.
So first time through, it can be a commitment. But it's one you need to do anyway. So if you look at the benchmarking process, incremental to the measures you should be using anyway, pretty straightforward. Hard part is getting the discipline and getting the measures calculated.
Okay. Thank you. Now, Lauren, what would you say this year was the biggest surprise for you coming out of the benchmarking study?
I think the biggest surprise this year was really seeing the growth and the strength of companies outside of the traditional tech centers like Silicon Valley and Boston and even some of the secondary tech centers like Austin or Seattle.
Mm-hmm.
Seeing companies across the country, which we've always had, but seeing pretty strong companies with $15 million or $20 or even $30 million in revenue, profitable, and maybe haven't gotten the kind of venture money that's more concentrated on the East and the West Coast, but seeing the growth of those companies, and I think it really speaks to the SaaS model, because you don't necessarily need to have companies concentrated all next to each other to get access to capital, to get access to different services. You can use remote services from anywhere for payroll, for sales management, for all sorts of things. And so it's allowed companies to spring up in a lot of what might have been considered unlikely areas like South Dakota. From previous times.
Now, you mentioned hybrid companies, and we certainly see them out there now. How do their benchmarks differ from other companies?
Hybrid companies are typically defined as companies that have a mix of revenue from perpetual license sales as well as subscription sales, and it makes it a little tricky for a variety of reasons. From a pure financial analysis perspective, it's tricky because obviously if you have a subscription revenue, you're recognizing the subscriptions ratably over the course of the contract, as compared to perpetual license revenue that you recognize all up front. So for sales and marketing, you're spending the same amount. Your sales and marketing dollars might be the same, but if you're creating an expense ratio against $1 million versus 1/12 of $1 million, the ratio is obviously going to be very different. And it's obviously also very different for hybrid companies because I think what we've seen is that previously a lot of companies that either tried to run two different businesses, a subscription business and a perpetual license business, or transition existing customers over to a subscription business would sometimes try and do that with the same sales organization. Other companies have tried to do it with completely separate sales organizations, so you may have competing sales with products that are the same and yet just have different licensing or payment options. And it really changes the metrics, but you see a large number of companies now that have successfully transitioned from being 100% perpetual license to majority subscription, and we have good benchmarks for that process and at different stages along the way, even though the ratios are impacted by the different ways that you recognize revenue.
Great, thank you. Now, Marc, there's a question about your gross margin calculation. Do you only take direct sales costs, or do you include customer support costs?
So all the sales costs are in that initial CAC number. The new sales to new customers would be that in the CAC number, and then ongoing support sales costs for the install base are in that renewal cost figure. In cost of goods, it is the gross margin is a fully loaded cost of goods, which would include all your hosting and operational costs, IT costs, whatever they are, hosting the actual SaaS service, all customer support, and any third-party product costs that might be in your product. So the only COGS item that's not in that is professional services, and since we're really talking recurring revenue here, professional services costs and professional services revenue are a separate calculation.
Great, thank you. We are at the top of the hour. I want to be very conscious of everyone's time. I want to say a very sincere thank you to Marc and Lauren for the content that you've provided today. I think it's been very valuable. If anybody has any additional questions for Marc and Lauren, please let us know, and we will definitely direct them to Marc and Lauren. Again, I want to remind everybody that we will be providing you with the recording and the presentations, and we will also make the recording and presentations available on our website. Certainly if you have colleagues or peers that you would like to share that with. So with that, again, thank you to Marc and Lauren, and I wish everybody a great rest of your week.
Thanks very much.
Thank you.
Thank you.
Bye.